Here's the pre-adjusted trial balance that we created in the first round of the full accounting cycle as we recorded the original transactions. In this second phase, when we deal with adjusting entries, we will review this pre-adjusted trial balance and its balances to determine which of these accounts will need to be adjusted to comply with accrual accounting, i.e. revenue recognition and matching principle. As we review these accounts, we may discover that some accounts are overstated and need to be decreased. Some accounts may be understated and need to be increased. In addition, some adjustments may result in accounts being added to the list because their pre-adjusted balance was zero. For example, you don't see any interest expense here, but since you have a note payable, the adjusting entry to accrue interest expense will result in an interest payable and an interest expense account, which currently isn't on the list. That may result in some accounts being added. What we're now going to do is go through each of these accounts one by one and talk about potential processes for coming up with the proper adjusting entries. Cash. Perform a bank reconciliation. By performing a bank reconciliation, you'll be able to identify unrecorded interest income, unrecorded deposits, bank errors which could increase or decrease the account balance, company errors that we've made on our own accounts that we need to adjust to increase or decrease our cash, unrecorded interest expense, unrecorded bank service charges, unrecorded NSF, that's non-sufficient funds, that's a bounced check, and fees, and unrecorded check printing fees. By going through the bank reconciliation, we could properly adjust the cash account, and some of these other accounts will also be adjusted because, as you recall, any journal entry will have a debit side and a credit side. Marketable equity securities. To adjust marketable equity securities, one thing you might do is obtain the current market values of the marketable equity securities to identify unrealized gains or unrealized losses. This is one situation where you can actually write up the value of this asset, and if the value has gone down, you would have to write it down and record a related unrealized gain or loss. Accounts receivable. You need to estimate the collectability of accounts receivable to identify necessary adjustments related to uncollectible accounts. So although people said they promised to pay you $1,000, what if you think that you'll only collect $800? So you'd have to create an allowance for $200 to write this down to only $800. Finished goods inventory. You'll need to evaluate and count the company's inventory to identify unrecorded sales, unrecorded theft, unrecorded damage, errors either in the cost or in the units, obsolescence because maybe the value's dropped. In US GAAP, inventory is accounted for at the lower of cost or market, which we'll discuss in a later accounting course if you choose to major in accounting. Misapplication of manufacturing costs. If this were a manufacturer, all the overhead costs of creating inventory would need to be applied properly to the inventory. And unrecorded purchases on account. Prepaid insurance. You need to compute the amount of prepaid insurance that has been used up and expense it accordingly. And review amounts expensed down below and verify that we didn't expense too much, thus requiring an adjusting entry to increase prepaid expenses and decrease the expense. Equipment and building. Determine the amount of depreciation that should be recognized on the equipment and on the building so that part of this could be effectively expense and you'd have a depreciation expense down below. Determine whether the equipment or building has been permanently impaired and needs to be written down. Accounts payable. Determine whether any accrued expenses need to be recognized. Any unrecorded inventory purchases need to be recorded. Commissions payable. Determine whether any sales have been recognized for which the commission has not yet been recognized. Utilities payable. Determine whether any utilities have been received and not yet been recognized. Notes payable. Determine the amount of interest that should have been accrued and adjust accordingly. Capital stock. Ensure all issued and outstanding stock has been properly accounted for. Dividends. Ensure all dividend declarations have been accounted for. Sales revenues. Review long-term contracts, agreements, shipping documents to ensure all revenues that should have been recognized are recognized. Cost of goods sold. Update cost of goods sold for what was learned during the review of inventory, as well as during the review of sales revenues. Commission expense. Verify that all commission expense has been recorded based on adjusted sales revenues. Utilities expense. Verify that all utilities expense has been recorded up to period end. Dividend income. Accrue all dividend income declared by investees.